What's up, traders? I've been following sector rotation for quite a while now, both in my trading and on this channel. And in the last few quarters, or last quarter, I have been a little bit confused as to the signal that it's been giving us. Like, are we at a market top? Are we going into a bit of a recession or bear market? Sometimes the sector rotation model can be predictive of the economic cycle and the stock market cycle. And it worked really, really well coming out of the 2020 COVID crash. But in the last few weeks, it's been giving us some conflicting signals. Well, this week was quite interesting because after coming off of an all-time high, apparently we were about to hit into recession if you read the news yesterday because of Delta variant fears. Well, as of today, I guess we cured that Delta variant because, it's not that big a deal anymore. But this price shock did us a great favor in revealing something about sector rotation. And I'm going to show you here in just a second. But first, let's review what I'm talking about. So this is the model, the theory of sector rotation. The model and the theory says that we can look at different segments of stocks, things in the technology sector, things in the consumer discretionary sector, and depending on their relative performance to the overall market, the SPY or the SPX, that will tell you if you're in a market bottom, a bull market, market top, or bear market. So you're looking to see which of these sectors represented by their ETFs are leading in these time periods, and that will give you some insight into what is to come. Well, this worked out really, really well coming out of the COVID crash. I'm looking at this relative performance from April, the beginning of April through June, basically quarter two of 2020, which was after that March crash. And if you're looking up here in the website, it's stockcharts.com, and you can find it here by looking at the relative performance here. You should be able to find it on the website. It's a very handy tool. And so if we look right here in that quarter two of 2020, consumer discretionary and technology were definitely the winners. And that's what the model would tell us, that at a market bottom, these two sectors would lead us out of it. And that worked very, very well. That was very predictive that we were in a market bottom. That's when tech started blowing up. Luxury goods are what you can consider discretionary. So all these things started leading us out of that market bottom. Go forward another quarter, and discretionary and technology are still pretty strong, but they've fallen off. And now what you see is industrials and materials, which is the second phase where we would see a bull market happening. Industrials and materials, according to the model, would be leading us as the bull market matured. That was definitely quarter three of 2020. Next up, energy really started to outperform in the final quarter four of 2020. And that is a big red flag that we might be at a market top. Well, it actually continued into quarter one of 2021. Energy was still leading. There was a lot of demand for energy, as there is when the economy is starting to roar, because economies need energy. And so they led. The thing that I myself inferred at this point was, okay, we've had several straight quarters of the model working just as we would expect, from technology and discretionary leading in the market bottom, industrials, materials as the market matured, and then energy signaling a potential market top. So consumer staples and healthcare were supposedly the next ones to go, and they have been underperforming, so they may be relatively cheap. Well, as we went into the second quarter of 2021, not quite exactly the case. The model breaks. But then again, that's the thing about economic models and theories. They're not always going to be 100% accurate. And so staples just did not really perform all that well. Healthcare did okay. Energy fell off. But the weird thing is that technology started to see a resurgence, which really confused me. Are we seeing yet another market bottom within a market top, or is this just an outlier? Well, I think that the latter is the case. I think this was just an outlier. And let's go back to the SPY and let's look at these individual ETFs because, as I said, this recent down move from the all time high on the 14th of July down to the bottom yesterday, if that is the bottom, we'll see. For now, it is. This little price shock right here, which was a move of, let's see, about 3.6%. Not a bear market 10% correction you'd want to see, but still a significant enough move to get people a little nervous. I think it's just summertime volatility, but it still gives us some insight. Now let's look at this real quick. So let's go through the ETFs and let's see how they did. So if we look at the consumer discretionary from the all-time high, which it also made, it was off 5.5%. So a pretty big down move, an outsized move to the S&P in consumer discretionary. Communication services down a little over 4%. Again, outsized. Technology down 4.21%. Also a little bit outsized, but still looks pretty bullish. The things that are looking sort of weak, industrials down 4.38%. Materials over 5%, 5.5%, very much underperforming the S&P. Energy down 12%, definitely underperforming. Consumer staples, that's a very different chart. And consumer staples were off less than 1%. In fact, it's recovered and actually made not quite a new all-time high, but definitely doing better than the other sectors. What about healthcare? Healthcare off 2.3%, not quite as bad as the S&P. Utilities, again, very different looking chart. It was only off 1% from the all-time high to yesterday's low, and it is looking pretty strong. Financials down 5%, and real estate, well, real estate is its own beast. So this move revealed where the money is potentially flowing as we get into this major market top. So while all the other sectors are showing their relative performance, we really want to look at the last week to see what sectors were the strongest. In other words, which one were the most defensive, which one held their ground against this move? What were people more interested in bidding up with the concern that the market might be hitting a major turning point? Well, if we go and we look at just the last 5 days, we can see a much clearer picture. We can see that what has outperformed is consumer staples, healthcare, and utilities in the last week. Now, this is just the last week, but it gives us a little glimpse into where we might be heading in the market cycle because, again, we're coming off of energy leading for the first 2 quarters of 2021. And now, if the model plays out as it should, consumer staples, healthcare, and then utilities should be outperforming the market as the market begins to roll over. Still around the top, but this could be an early warning sign of the money flowing into more defensive plays. It doesn't mean that the market's going to crash. It doesn't mean that we're even going to go through a full 10% correction. What it gives us a glimpse to is where money is positioning itself in more defensive plays as opposed to more aggressive growth plays like tech and energy and things like that. So keep an eye on these sectors. And if you want to look for stocks that are in these sectors, I would recommend looking up these ETFs and their major holdings, and that will give you some very good volume, heavily traded products and stocks that you yourself could be looking at to get in to also move with the way the money's moving in the market. So hope this is useful to everyone. We'll see you in about a month. Well, see how this played out. Trade wisely.